Why is everyone constantly looking at this chart? What does each of these bars mean? Why is one thick and another thin? Why is one long and another short? When and who decides that one bar should transition into another and even change color in the process? I've broken down all these elements to their molecules, and in this video I'll show you the meaning of every small detail and how to use it to make money in trading. Let's start with these colorful bars called Japanese candlesticks. What are they? A Japanese candlestick is first and foremost information about how the price of an asset behaved over a certain period of time. For example, if you open a daily chart, one candlestick will represent the price movement over one day. Often candlesticks are shown in these two colors, green and red. But what's the difference between them? If the price of an asset at the end of the day is higher than at the beginning of the day, a green candlestick forms, indicating that the asset has risen. This means that the buyers were stronger than sellers. Similarly, a red candlestick forms if the price at the end of the day is lower than at the beginning, indicating that sellers were stronger than buyers. To understand this, we can look at the chart not only for one day, but also for 15 minutes or any other time interval. The principle remains the same. It's like zooming in and out on Google Maps, but you're still looking at the same area, just from different distances. But why do most traders use Japanese candlestick? It's simple. They are the best tool for understanding price movement. A candlestick consists of two parts, the wick and the body. The top of the upper wick shows the maximum price, and the bottom of the lower wick shows the minimum price for the selected period of time. The body of the candlestick works a bit differently. For a green candlestick, the bottom of the body is the opening price and the top is the closing price. For the red candlestick, it's the opposite. The top of the body is the opening price and the bottom is the closing price. But is this enough to understand the chart at a basic level? Not at all. Before diving deeper, we need to figure out what actually influences the price movement up or down. We need to fully understand and break down two basic concepts. Without this foundation, there is no point in looking at these charts. Why does the price rise or fall? For example, I want to sell my Bitcoin for $1,000. I place a sell order on the exchange, which looks like this. This is the list of all sell orders. Other people see that Bitcoin is being sold at 40k and they start setting the price slightly higher, say $40 or $100. If someone buys at that price, the next seller set their prices even higher. This is essentially a demonstration of supply and demand. Sellers continue to raise the price as long as there are buyers willing to pay that price. The same principle works in reverse, but you should understand that this is a highly simplified explanation to give you a basic idea how it actually works. Such simple breakdowns of basic tools and the best ways to make money in crypto are what I shared in my free Telegram channel. Recently, there was a post about a tool that gave me plus 40% return in a month on absolute passive income. I leave the link in the description, but let's get back to the charts and candlestick. Subscribe right now. Here we need to understand that the body of a candlestick shows the strength or weakness of buyers or sellers. For example, here we have two green candlesticks. The left one has a large body and relatively small wicks. The price opened here and sellers tried to push the price down, but they were very weak because buyers quickly stepped in and pushed the price higher. Buyers were able to move the price a significant distance without much pressure from sellers, resulting in the price closing very close to the high. This shows that buyers were significantly stronger than sellers during this candlestick. In the second candlestick, the story is different. The price opened here and buyers started pushing the price up to a new high, but at the peak, sellers stepped in and pushed the price back down, and sellers were strong and almost completely covered the distance back to the opening price. But buyers barely managed to close the price above the opening. In this case, we see that the buyers were stronger than sellers, but the difference in their strength was minimal. If the body of the candlestick is relatively larger than the wicks, it shows that either buyers or sellers were in control. On the other hand, if the body is smaller than the wicks, it indicates less control from both sides and a tough battle between buyers and sellers. When we notice a long wick above or below the body, it gives us an important clue about price movement. What does it mean if we see a long wick above the body? It means that sellers are strongly selling at these levels and buyers will need a lot of effort to push the price higher. Similarly, if we see a long wick below the body, it tells us that the buyers are strongly buying at these low levels. If sellers want to push the price lower, they'll have to overcome these buyers. Understanding the body and the wicks is key to understanding basic Japanese candlestick patterns. Now let's move to the main question of of trading, when to buy and when to sell. To answer this, we need to know basic patterns or behavioral templates. It's like green and red lights for a driver. At first, it's better to have someone who can confirm or deny your hypothesis about whether to buy or sell. That's exactly why we created our closed community, where we give clear recommendations on what to buy, what to sell, and when to do it. This works for both spot and futures trading. And of course, there are mentors who will answer any questions at any time. I will leave link in description and you can join right now. And now let's master these patterns. The first pattern is the bullish pin bar, a strong reversal pattern in the Japanese candlestick that indicates a potential upward reversal. This candlestick consists of three elements: a small green body, a long lower wick, and a tiny or absent upper wick. How can we explain what we just saw? The price opened around this area and sellers immediately tried to push the price down. They managed to lower the price, but at some point lower price triggered buy orders from buyers, and buyers were significantly stronger than sellers because although sellers tried to crash the price, buyers stepped in and pushed the price above its opening. How can this be useful in the real life? If a pin bar appears after a strong decline, it indicates that sellers have lost their strength and buyers are now stepping in to push the price up. To start trading, we need to consider other factors to confirm our opinion, and we will discuss about it later on this video. But if we find a buying opportunity for such a pin bar, we can place a buy order above a pin bar's high, set a stop loss below the pin bar, and target the next resistance level. The second pattern is the bearish pin bar, the opposite of the bullish pin bar. It's a red candlestick with a small body and long upper wick and a tiny or absent lower wick. It indicates a downward reversal. Let's break it down. The price opened here and buyers started pushing it up. They overcame some distance and created this high. Then sellers started selling and pushed the price down below the opening price. And sellers managed to keep the price below the opening and the candlestick closed near its lows. At that moment, sellers gained an advantage over buyers. If we find another confluence at this point, we can place a sell order below the pin bar's low and keep stop loss just above the pin bar. If you don't fully understand how to technically trade, like which buttons to press, what a stop loss or take profit is, be sure to watch this video where I show how to trade futures on Bybit. I leave the video right here, somewhere here, and separately in the description. I believe Bybit is the best exchange for this task right now, and when you register using my link, you get up to $30,000 in trading bonuses. The link will be in the description, so do it right now and get this cool bonus. But let's get back to the patterns. The Doji pattern is the only candlestick pattern that doesn't give us information about where the price will go, but it's important to understand. It's characterized by a candlestick with a roughly equal upper and lower wicks and a small body. The opening and closing prices are somewhere in the middle, and the body is very small. This shows that buyers and sellers were not much stronger than each other during this period. Does the Doji tell us anything? No, it can only indicate a short pause in the movement. But if we see several Doji candlesticks in a row, it tells us that buyers and sellers are fighting for dominance and there is no clear winning side. In such a situation, the price usually makes a sharp move in either directions. The bullish engulfing pattern consists of two candlesticks where a green candlestick completely engulfs the red one before it. Simply, we first see a red candlestick, then a green one, with the green candlestick's high above the red one's high and its low below the red one's low. What happened off the chart? Sellers were in control during the red candlestick. When a new candlestick opened, the price dropped and broke the previous low. But suddenly buyers stepped in. They overpowered sellers and pushed the price above the previous high. Buyers covered more distance than sellers, meaning they are now in control and ready to push the price even higher. To enter the trade on the breakout of the high, we can place a stop loss below the candlestick's lows. The fifth pattern is the bearish engulfing, which is essentially a two candlestick pattern where a red candlestick completely engulfs the green one. The red candlestick's low is below the green one's low and its high is above the green one's high. What does it mean? Initially, buyers were in control as the price moved up. When a new candlestick opened, buyers tried to push the price higher, breaking above the previous candlestick's high. But sellers saw an opportunity to profit at this high and started selling. Their pressure was so strong that they managed to push the price below the previous low, and sellers covered more distance than buyers, meaning they've taken control of the market. Therefore, we can place a sell order below the low of this candlestick and set a stop loss above its high. The sixth pattern is the morning star, a free candlestick pattern indicating a bullish reversal. The first candlestick is a strong red one with a large body. The second is a doji with a small body and long wicks. The doji can be either green or red. Then there is a large green candlestick that closes above doji's high. The sides of the candlestick determine the strength of the pattern. If the green candlestick is the same size as the red one, it's a good trading opportunity. If the green candlestick is smaller, it's a low probability to trade. Finally, if the green candlestick closes above the red one's high, it's a strong reversal candlestick. Let's break down the psychology of this pattern. First, we have a red candlestick showing that sellers were in control. They pushed the price down. Then buyers stepped in and pushed the price up. And finally, sellers completely lost the battle and buyers pushed the price even higher, creating this green candlestick. Buyers changed the situation and now we are likely to see upward movement. To profit from this pattern, we place a buy order above the green candlestick's high and set a stop loss below the doji. The seventh pattern is the evening star, the complete opposite of the morning star. Here we have a free candlestick pattern where the first candlestick is a large green one, followed by a small doji and then a large red candlestick. The psychology of this pattern tells us that initially buyers were in control, creating the green candlestick. Then sellers stepped in and challenged buyers, resulting in the doji. Finally, sellers won the battle and started pushing the price down. To enter a sell trade here, we place an order below the low and set a stop loss above the doji.